Good evening. This is Doc Severson for the Theonite Report for Thursday, January 4th. I'm starting off today's report on the S&P, and since last week's or last Friday's close, we've jumped up about 50 points within the span of 3 days. So this is outside the Bollinger Bands now. We've had more than a 2 standard deviation move to the upside. We're well above that expected move for the week. Here's the spider chart, and you can see the expected move that I had for tomorrow set up here on this. And we had about a 2.9 point expected move for the spiders, or about 29 handles on the full S&P, and so far we've just about doubled that. So going over to the full S&P index here, the cash index, this is where we get into the very rare signal once again, where we've been seeing this a number of times in 2017, and now we're seeing it once again, is that we have what's called triple exhaustion. So across all time frames, we have a level of linearity to this trend, which is so linear. Look at this. I mean, you can almost put a ruler on these things, and we're starting to see that real parabolic move up to the final, well, the final push to the upside, at least for an intermediate term. And this is typically what we find, is that once we see triple exhaustion, the last time that we really had this triple exhaustion was last year around this time, at the end of February in 2017, we had this triple exhaustion really bad. So we still have a little ways to go before it's going to go to the same level here. Now, the one difference that I'm seeing now versus back then is I don't see the same level of divergence. So what I'm seeing is I'm seeing more of the various sectors of the S&P actually contribute to this rally. Before, it was just a few large big dogs that were pushing everybody higher. They're still pushing higher, but now what we're seeing is a greater participation rate across the board on the S&P. So one thing I can look at is here at stockcharts.com. And I've noticed, I've brought this to your attention several times recently, where we've seen this big divergence showing up. So as prices are hitting all-time highs in the S&P, we see this divergence. And what this is, again, this is the percentage of stocks above the 200-day moving average. So when we see that number start to really drop, where we only have 60% of the S&P above the 200-day moving average. Remember, when a stock drops below the 200-day moving average, essentially it's in a downtrend. It's in a longer-term downtrend. So you have to ask yourself, how on earth could we be hitting all-time highs when fewer and fewer stocks are in an uptrend? And really the answer to that is because we have these very large behemoths such as Boeing, and we have Amazon, and we have Google and Microsoft that just are driving the rest of the market. So that's not the case right now, though. That is not the case. Right now, we're back up to about 80% of stocks above their 200-day moving average on the S&P, which is not bad. I mean, this is typically about as much as we see. So what do we do from here? Well, again, what I still believe is that by the end of January, we'll have ourselves a modest little 3, 4, 5%. It's not really even going to be necessarily technically a correction. But it will be a little bit of a soft patch, I believe, at the end of January. So that doesn't mean that the S&P can't push as hard as it can right now. Think about it. After 3 days, we already have fund managers that are behind the S&P 500, but maybe not quite so early as this year. All right, so let's go back to the chart. What do we do with this thing? Again, what I can't do is I can't chase after this. I can't chase after the S&P into all-time highs at this point. And oh, by the way, let us throw a little bit of respect to the Dow. I'm sure it's all over the financial stock media today that we went above 25,000. I can't look, right? So I stopped looking at that years ago. So yeah, it hit 25,000. It's a price-weighted index. We have stocks out there that are like Caterpillar. Well, let's try the spell here. Caterpillar is, going berserk. It's Boeing has been the number one, and Boeing is sitting here in a tight little flag. Now, this is one of the things that I want to bring to your attention today is what can we do with this right now? Well, what we will see very likely over the next few days is some type of rotation from stocks that have started off the year extremely strong to ones that have not started off the year very strong. And some of these, what we're going to find is that they're in very tight consolidation patterns. In fact, what I have is I have a specific scan that looks for those. This is what I call a whale scan. And what I'm looking for is, again, if you think of the term whale, most of the time these mammals, you just don't see them at all. They're below the surface of the ocean. And then once in a while, they just pop out of there, and then, they're very visible at that point. So what we're looking for is these stocks which are kind of under the radar and nobody's paying any attention to. And what they're doing is they're below the radar. They're coiling up. They're building up a lot of short-term energy, and they usually attract a lot of attention when they finally break out from those levels. So everything's breaking out. Everything's moving higher right now. Our job is to find the next list of stocks that might be breaking higher. And this is what we look for in this scan, is I'm specifically looking for weekly and daily. So I'm looking for two different time frames that are correlated here. So we're looking for a parent time frame as well as a daily time frame. Forget about the monthly these days. Who cares? The monthly has not mattered all through 2017. It's been an exhaustion with this crazy rally since that point. So right now, that's just a non-factor that I'm having to learn to look through. Eventually, at some point, we will have to pay for that. We will see corrective price action come into the market, and we will watch that monthly chart recharge itself through corrective action. But it's not happening yet. And the strength of the S&P is showing it that there's no undercurrent right now, which is starting to roll into a bear market, as we saw back in 2015. Okay, so again, this scan, what we're looking for is three things here. Looking for the weekly chart to show a lot of consolidation, a lot of energy, above 55, that's a lot. That drives a lot of power behind that, as well as the daily chart. So both of these charts have to be in consolidation. Not going to necessarily find a whole lot of candidates that fit that description right now. Okay. And also we want this to be above the 200-day moving average. So generally in an uptrend, we're going to look for that. So I've got 6 hits tonight against my watch list. And so we can see right now one of them is Bristol Myers Squibb. This is kind of a sloppy chart, but you can see all of this nonlinear action where the rest of the market's breaking higher. Bristol Myers Squibb is basically sitting in a pennant pattern right now, building up energy, but this is very common for something that might break higher from here. Now we are coming up on earnings. So earnings is coming up in less than a month on Bristol Myers. A lot of times the frustration that we have is we get these great patterns and they're in consolidation for a reason, because the overall market is waiting on those earnings reports before they will start to move. So there's Bristol Myers. Here's Citi. Now, Citi's actually showing a nice pattern. This is a very small little flag that's setting up here. You can see this very defined on the daily chart. So I would expect to see this break higher. It's more than likely going to be breaking higher with the rest of the financials. So if you look at the financials by themselves, we're starting to see the overall financial ETF breaking higher from here from a fairly large energy. And it does not have this on the weekly chart because the overall sector has been so strong lately. But look at this. We're starting to fill in the triangle here on the financials. Who'd have thunk it after all of those regulations kept these things down for a long time? Let's look at the next one, which is ironically Goldman Sachs in another flag pattern. Goldman Sachs, the evil empire, is in a flag pattern here, threatening to break higher from here, and quite a ways away from any earnings. Looks like that is not the case. It looks like we will have earnings on these in mid-January, so that's coming up a couple weeks from now. So Goldman Sachs may be a difficult one to take. Next one up is Coke. So Coke, pretty sloppy pattern here. It does not move, and it spends most of its time consolidating and then occasionally moves. That's not something I want to do. So here's Medtronic. Medtronic, very sloppy pattern, not really interested in that. And yet another bank here. So banks have been sitting here coiling, waiting for their turn. And guess why you think they're coiling? Because we have earnings right around the corner here. So it may be that many of the ones that we want to get into, we can't because of the fact that we have earnings so close. And with implied volatilities rising into that, may not be the best trade unless you're just an overall stock trader. Now, some of the ways that you can kind of open up this scan if you wanted to is you can say, well, the weekly chart, I don't care if it's super charged up. I can bring this down to something like over 40, 45. So you can kind of tone down this scan if you want to get more hits and see potentially more setups going forward. Again, I think we'll have a few weeks, perhaps a positive price action to the upside yet, as money continues to come in from the sidelines, wherever that's coming from. So again, I don't know what the catalyst is going to be that might cause weakness at the end of January. Just notice this as a historical pattern that does pop up when we have a super strong year. The next year is typically not quite as strong. It's still okay. It will start off strong in January, but the back half of January tends to be relatively weak, and we'll use that as an opportunity going forward. All right, folks, that is it for tonight's report. Thanks for listening. We'll see you tomorrow.